Gold is rising again, and once more, the explanation sounds familiar. Headlines point to inflation. Commentators talk about consumer prices, purchasing power, and the cost of living. The story is simple. Prices go up, currencies weaken, and gold responds. It sounds intuitive, it feels logical, and it's the explanation most people stop at. But there is a problem. Inflation, as measured by official data, has not been accelerating in the way this narrative suggests. In some cases, it has slowed. In others, it has stabilized. Yet gold continues to move higher, often at moments that do not line up with inflation releases at all. That mismatch matters. If inflation were the primary driver, gold's behavior would be more predictable. It would rise in response to consumer price spikes and cool off when those pressures ease. Instead, gold often moves quietly, steadily, and sometimes abruptly, without the kind of inflation shock the headlines are pointing to. This tells us something important. When an asset keeps moving in a direction that the popular explanation cannot fully account for, the explanation is usually wrong, or at least incomplete. The price is reacting to something else, something that does not show up in monthly inflation reports, but still shapes the decisions of the largest actors in the system. To understand why gold is rising, we need to stop looking at prices alone. We need to look at behavior, specifically whose behavior matters when policy choices narrow, options disappear, and long-term risks begin to outweigh short-term data. That is where the real story begins. If inflation were truly the reason gold is rising, the pattern would be obvious. Gold would move higher when inflation accelerates and struggle when inflation cools. It would react sharply to CPI releases, wage data, and consumer price surprises. The timeline would make sense. Cause, then effect, but that is not what we see. In several recent periods, inflation data has come in lower than expected. Some measures have slowed meaningfully, and yet, gold did not weaken in response. In some cases, it rose shortly after. In others, it barely reacted at all, continuing a trend that seemed disconnected from the numbers everyone was watching. That disconnect is the key. Inflation is a consumer-level phenomenon. It measures the price pressure felt by households. Gold, however, has never been a consumer asset. It does not respond to grocery bills or rent increases. It responds to balance sheets, monetary constraints, and long-term credibility. When inflation spikes suddenly, gold can react, but sustained moves in gold rarely come from consumer price stress alone. They come from something deeper, from structural pressures that make policymakers uncomfortable, not shoppers. This is why the inflation narrative is so appealing. It is simple. It gives people a clean explanation. But simplicity is not accuracy, especially in a system where the most important decisions are not made by consumers, but by institutions operating on entirely different timelines. If inflation were the driver, gold would be reacting to data releases. Instead, it is reacting to conditions that develop quietly, often long before they show up in official statistics. To understand those conditions, we need to shift our focus away from headlines, away from price charts alone, and toward the actions of those who are not trading based on monthly reports, but on long-term policy realities. That shift changes the question completely. The question is no longer why gold is rising. The question becomes who is acting and what constraints are forcing their hand. When prices move, most people ask why. When systems shift, the better question is who. Gold's movement starts to make sense only when we stop treating price as the cause and begin treating it as the result. Prices react, behavior leads, and in markets shaped by policy, the behavior that matters most rarely comes from traders reacting to data. It comes from institutions responding to constraints. Look at who is consistently involved on the buy side when gold rises without obvious inflation pressure. It is not households. It is not short-term speculators. It is entities that operate with long time horizons and very limited tolerance for policy risk. Central banks do not buy gold because they expect a good quarterly return. They buy it because gold sits outside the policy tools that governments can change overnight. It does not depend on interest rates, fiscal promises, or future growth assumptions. It simply exists, independent of the system that surrounds it. This distinction matters. When gold rises during periods of weak inflation data, it signals that the marginal buyer is not reacting to consumer prices. The buyer is reacting to something else, something more fundamental, something that affects the architecture of the system rather than the experience of the consumer. This is why focusing on charts alone leads to confusion. Charts show what happened, not who caused it. Behavior reveals intent, and intent reveals pressure. Once you start watching behavior instead of headlines, a different picture emerges. Gold is being accumulated quietly, steadily, and often during moments when the public narrative says it should not be moving at all. That tells us that the decision to buy is not driven by fear of inflation today, it is driven by preparation for policy constraints tomorrow. To understand those constraints, we need to look at the policies shaping the system's boundaries. And that brings us to the role of the United States, where those boundaries are becoming increasingly tight. To understand why gold is responding to policy rather than inflation, we need to look at the position of the United States, not as an economy, but as the anchor of the global monetary system. For years, low interest rates made growing debt manageable. When borrowing costs were near zero, deficits could expand without immediate consequence. That environment no longer exists. Higher rates have changed the equation, not gradually, but structurally. The issue is not whether rates go up or down next month. The issue is that the system now carries a level of debt that reacts very differently to higher borrowing costs. As rates rise, the cost of servicing that debt increases automatically. There is no policy decision required. The pressure appears on its own. This creates a narrow corridor for policymakers. Raising rates aggressively risks destabilizing credit markets and public finances. Cutting rates too quickly risks undermining confidence in the currency and reigniting asset inflation. Holding rates steady extends the pressure without resolving it. None of these options are clean. This is what a policy trap looks like. When policymakers face constraints rather than choices, markets adjust accordingly. Gold does not need inflation to rise in this environment. It only needs policymakers to remain boxed in. As long as the system's debt dynamics limit what can be done, gold retains its role as a hedge against policy rigidity. This is why gold often strengthens during periods of uncertainty around interest rates, even when inflation appears under control. The market is not reacting to what policymakers say, it is reacting to what they cannot do. And this dynamic does not exist in isolation. It shapes how other countries interpret risk, particularly those with large reserves and long-term exposure to the dollar-based system. To see how that plays out, we need to shift our focus beyond the United States and look at how policy constraints are viewed from the outside. When policy constraints tighten in the United States, they do not go unnoticed elsewhere. For countries that hold large reserves and depend on long-term stability rather than short-term returns, these constraints carry a different meaning. Central banks do not evaluate risk the way markets do. They are not looking for momentum. They are not trading volatility. Their concern is exposure. Exposure to currencies, to political leverage, and to systems that can change rules under pressure. This is where gold enters the picture in a very different way. For countries like China, gold is not an inflation hedge. It is a strategic asset. It reduces dependence on external monetary policy. It sits outside the influence of interest rate decisions made elsewhere, and it offers neutrality in a system where neutrality is becoming harder to maintain. This helps explain why gold accumulation often accelerates quietly, without dramatic price reactions at first. These purchases are not meant to signal anything. They are meant to rebalance risk over long periods of time. What matters is not the monthly price of gold, but its function. Gold does not promise yield, it does not depend on economic growth, and it does not require trust in future policy coordination. For reserve managers, those characteristics are not weaknesses. They are the point. This behavior becomes especially relevant when large economies begin to diverge in how they manage monetary pressure. As some rely on financial markets to absorb stress, others move stress outside the market entirely into assets that do not need to be rolled, refinanced, or defended. Gold fits that role. When multiple central banks act this way at the same time, price becomes a lagging indicator. The accumulation happens first, the narrative follows later, and by the time the story becomes obvious, the positioning has already been done. To understand how this disconnect plays out in markets, we need to look at the difference between how prices are set and how policy decisions are made. That brings us to the divide between paper markets and policy action. Paper markets move fast, policy moves slowly, and this difference explains much of the confusion around gold's behavior. In futures and derivatives markets, prices are set by expectations, leverage, and short-term positioning. These markets react instantly to headlines, data releases, and changes in sentiment. They are designed for speed and liquidity, not for long-term stability. Policy action works on a different timeline. When governments and central banks adjust their exposure, they do so quietly and deliberately. They do not announce purchases in real time. They do not respond to intraday volatility. Their decisions unfold over months and years, often through channels that never appear on a trading screen. This creates a persistent gap. Paper markets can push prices down temporarily, especially during periods of tightening liquidity or forced selling. But policy-driven accumulation does not disappear when prices fall. In many cases, lower prices simply make accumulation easier. This is why gold can experience sharp pullbacks without breaking its broader trend. The short-term price reflects market mechanics. The long-term direction reflects policy reality. Understanding this gap is critical. Without it, price movements look contradictory. With it, they become coherent. Gold is not rising because traders expect inflation next quarter. It is rising because policy actors are managing risk in an environment where traditional tools are losing flexibility. As long as that environment persists, the tension between paper markets and policy behavior remains. And that tension is exactly what keeps gold moving, even when the headlines say it should not. The implications of this dynamic go beyond gold itself. They point to a system where stability increasingly depends on assets that sit outside the reach of rapid policy adjustments. To see why that matters, we need to examine what gold does not require in order to rise. One of the most persistent assumptions about gold is that it needs fear to rise. Panic, crisis headlines, a sudden loss of confidence. But the current environment challenges that idea. Gold does not require retail participation to move higher. It does not need headlines predicting collapse. It does not need a rush into safe havens. What it needs is a narrowing of options at the policy level. When policymakers face constraints, they begin to prioritize resilience over efficiency. This shift is subtle but powerful. It changes how risk is managed, not how it is talked about. And gold benefits from that change without needing public anxiety to lead the way. In systems under stress, the most important adjustments often happen quietly. Balance sheets are reweighted, exposure is reduced, neutral assets are favored. None of this shows up as panic. It shows up as persistence. This is why gold can grind higher, even during periods of relative calm. The movement is not driven by emotion, it is driven by necessity, by the need to hold something that does not rely on future coordination or policy precision. Retail investors often arrive late to this process because they look for signals that never appear. They wait for fear. Policy actors move without it. By the time concern becomes visible, the structural repositioning is already underway. Gold's current behavior reflects that reality. It is not responding to noise, it is responding to limits, and those limits have consequences that extend beyond price movements. They shape how the system prepares for what comes next, even when nothing dramatic appears to be happening. To understand the broader meaning of this shift, we need to look at what it implies for the system as a whole. When gold rises in response to policy rather than inflation, it tells us something important about the system itself. It suggests that stability is no longer being created through growth or coordination, but through risk management. In a system with abundant flexibility, assets compete on returns. Capital flows toward productivity, yield, and expansion. Gold plays a smaller role in that environment because opportunity is plentiful and policy tools are effective. That is not the environment we are in now. As policy options narrow, the system begins to value neutrality. Assets that do not depend on refinancing, political alignment, or precise timing become more attractive, not because they offer upside, but because they reduce dependence on decisions that may be constrained or delayed. This shift does not happen overnight. It unfolds gradually, often unnoticed. But once it begins, it changes how stability is defined. Stability is no longer about maximizing growth. It is about minimizing exposure to policy failure. Gold fits into that framework naturally. It does not solve problems. It does not generate solutions. It simply exists outside the need for them. And in an environment where solutions are increasingly difficult to implement, that quality becomes valuable. This does not mean the system is collapsing. It means the system is adapting. And adaptation, in complex systems, often looks like stagnation or confusion before it looks like resolution. Gold's rise, viewed through this lens, is not a prediction. It is a signal that the system is preparing for continuity under constraint, rather than expansion under confidence. To bring this back to the question we started with, we need to summarize what gold's behavior is actually responding to, and what it is not. Gold is not rising because inflation is out of control. It is rising because policy is. Inflation makes for an easy explanation. It is visible, familiar, and measurable. Policy constraints are not. They develop quietly, behind balance sheets and institutional decisions, but they are far more powerful. What gold is responding to is not higher prices at the consumer level. It is the recognition that the tools used to manage the system are becoming less flexible, that choices are turning into trade-offs, and that some risks can no longer be managed through timing alone. This is why gold's behavior often looks confusing when viewed through the lens of headlines. The asset is not reacting to stories, it is reacting to structure. Understanding this does not require predictions. It does not require fear. It requires recognizing that in constrained systems, neutrality becomes valuable, even when nothing appears to be wrong. Gold's rise is not an argument. It is an observation, a reflection of how the system is adjusting to limits rather than expanding into opportunity. And as long as those limits remain, gold's role will continue to make sense, regardless of how inflation data moves from month to month.